Hello and welcome to FinTech Diary. Every week we speak to an industry expert who's part of the FinTech revolution. In the world of FinTechs, which is based on constant evolution and innovation, we question change makers on how they plan ahead and read the future developments. In every chapter of the FinTech Diary, we get the breadth and depth of every segment related to FinTech. My name is Amol Dete, and my guest for this chapter today is Shachindra Nath, Vice Chairman and Managing Director, GRO Capital. Shachindra, glad to have you. Before we begin, could you just give us some sense or some statistics in terms of how many loans do you disperse on a daily basis, monthly basis, and then annually? What's the average ticket size of the loan? Who are your target customers, specifically in the SME and MSME segment? And how's GRO doing?
Thank you, Amol, for hosting me. You're right. The fintech ecosystem is constantly evolving. Was born with the aspiration to build and service, become the largest small business financing platform of India. We began our journey in 2018 when in a listed company, we raised roughly around 1,000 crore of capital. We have seen and suffered both the post-ILFS crisis and the pandemic. But I think so our belief in data and tech and what can be done for small businesses have not changed. And, fact is that today we are more than 3,500 crore of total loan assets under management. We have serviced more than 22,000 customers in India. We are, present across the 100 plus location. We service more than 2,000 plus PIN codes. We have actually, our average loan ticket size would be roughly around 17 lakh. But more so importantly, the kind of impact which we have created, both in terms of the, supporting our customers during the pandemic period, the new employment generation, women employment and other things. Our belief is that, as like in consumer financing, next 3 to 5 years, you will see an explosion of SME financing being done on the power of the data. Historically, the small business financing has been done largely basis what we call the collateral-led financing done through physical assessment, but that is changing dramatically in few years to come, and I would be happy to talk about it.
Shashindra noted your points, and we can see, in fact, the rally specifically on the lending side based on the data, or we can call it an alternate data, where the fintechs are actually building alternate credit scores and helping SMEs and individuals and MSMEs to disburse the loans far more seamlessly. But since you mentioned about in next 3 to 4 years, you see the explosion of data specifically in the SME space, and the loans will be disbursed on the explosion of data and all these points. I have a very important question, and I'm just trying to learn here because every fintech, every NBFC, every bank is trying to tell us that we are trying to solve the unsolved problems or unresolved problems of the SMEs and MSMEs. Now, this statement has been made by a lot of fintechs these last 4 to 5 years. So I'm just wanting to understand how much problem have we resolved of the unresolved problem till now, and is there any measurement that is available to check that this is the problem that we have resolved till now, because the data, the credit score, the fintechs are already in this segment for the last 5 to 6 years, Sachin.
Yeah, I would say less than 1%. So the credit gap for small businesses is staggering more than 550, $600 billion. Small businesses contribute roughly around 38% of our economy and have around 11 crore people employed in that, 6.3 crores of total, MSMEs in India. After the inclusion of retail trade as an MSME, actually this number is more than 10 to 12 crores, right? Because in every tier 2, tier 3 town, your neighborhood shopkeeper is also an MSME as far as priority sector is concerned. But let me, so I think there is a lot of hype about fintech, the data, the technology. As you rightly said that everyone says that we are trying to solve it. But what is being solved and what is the problem? See, look at this way. Think of 5, 7 years back and think of a lender. There are two sets of problems. Think of a lender first going and trying to give a loan to a small business. Now, for giving a loan, you need three things. You need an assessment that the customer or a small business would be able to service the interest. And second, that he would be able to pay the principal back. Now, how do you come to that assessment? You come to that assessment by looking at what's your revenue, what's your margin, and whether you have enough cash flow or not. Now, when you go and reach to a small business or a small manufacturer in a small city and say, sir, what is your revenue? The answer was, oh, my revenue, you cannot see it because it is not on my books. Right? So that was the first problem, which means that assessment of revenue which generate the profitability which can repay the loan was not visible, which means that you have to do a lot many other things and figure out. Second, where you will pay the money to us. Again, the answer was, oh, all of my money comes not in my books, but somewhere outside. And then, the lender would think this guy is promising that he has X amount of revenue, but I can't see it. This guy says that he has a lot of money coming to him, but I can't see it. Then poor lender would do what? Say, okay, then give me your property, I will lend against the property. Right? So that is the problem. That was the problem, which we said, and lending for SME was only driven by collateral. Now, collateral has a capacity constraint, right? If I'm a small business, I have one house, one commercial property, and one shop or one factory, and I have already pledged that and taken loan against that. Now, next time I need more credit, where I get the credit from? But this core thing is changing. And while most of the small business don't like it started changing from first demonetization and then changed drastically from the implementation of GST. Because what is happening that almost a large portion of small businesses by force had got into the formal economy. Now, where you have a data set which is called GST, once you pull that data, you get 400 plus parameter wherein the quality of the turnover of a small business can be automatically analyzed. Who you sell, when you sell, what time you receive an order, what time you make an order. So that's the first point of assessment. Second, what we call the digitization of banking. And now account aggregation is also having started. But if you look at, now because majority of the business, at least in certain sectors of MSME, is in through formal economy, the turnover is reflective is banking. So if you upload 2 years of bank data, actually like a salaried employee, you can do a lot of analysis automatically that what is the residual cash flow available to SME and what turnover is getting reflected. If you sold to some goods or services to somebody, in what period of time it came and into your bank account. Third pillar is what we call the bureau population or the bureau maturity. So one of the reasons today you can walk in a Chroma store and buy a fridge in 5 minutes or 10 minutes because you have a bureau score which is associated with your mobile number and your bureau score defines what kind of default ratio you will generate. Now more than 1 crore data around MSME bureau score is also there, which gives the behavioral analysis. So bureau is not just a cutoff score. It is a factor of how do you behave, how many your checks get bounced, how many loans you are applying. If you think of this, and this is what we call in UGRO the power of the data. If you combine the three, which is our data tripod or UGRO score, you without talking to the customer can assess all the three things: his intent, his eligibility, and his ability to pay, and say yes and no to customer within minutes, right? The second portion is which we call technology, which is nothing but process simplification. How easily you can reach to the customer or without physical document, you can onboard the customer. So this is the power of data and technology. Today we process more than 350 crore of loans every month. We don't ask any customer the balance sheet, the P&L statement, the income tax return, so on and so forth. This is what gives us the power to assess the customer and grant him the loan. And obviously, if the customer has found, ability to provide collateral, his pricing of the loan, changes accordingly. If on this assessment, if you come and say, I also have a self-occupied residential property to offer, I will be giving you a loan at 11%. But if you say, I have nothing to offer, I will give you a loan at 17, 18%. So depending upon that, the pricing get defined. Second, which is also unique, where the lenders historically have struggled, SMEs are a non-homogeneous, by nature. So a dentist and IVF clinic are two different type of doctors. They are not same. A specialty chemical company and a chemical company are two different type of business. In hospitality, a banquet hall and a fast food chain are two different types of business. But lenders historically used to look at all businesses through single lens. And that's why under our data plus tech, we have built what we call our sector and subsector deeply specialized underwriting platform so that we can assess the customer by their time and not in a generalized basis. And I think so this is the way the problem is getting solved. Now everyone has different method of it. I think so whether it is fintech or whether it is conventional lending, I keep saying NBFCs are becoming bank, banks are becoming fintech, fintech are becoming bank. So it is actually all in the same universe. Different people have to play different role, but technology is driving credit and credit disbursement and collection in our country and globally as well.
So meaningful thoughts, Shachindra, here, and I agree with what you said. Technology will drive and everything, and data, the power of data, whether you call it oil or whether you call it a world war, based on data. I want you to elaborate more in terms of how actually you are using data. Obviously, you gave some GST points. You looked at the revenue and try to match the two different points. But what makes you confident? That okay, this XYZ SME is eligible according to you, and you will lend to it because there were banks and NBFCs perhaps did not lend to him earlier, and maybe there were different reasons. So, what kind of data are you generating from him, and what makes you confident to lend him?
We are not creating any rocket science. We are not. See, what our view is that data is nothing but is a reflection of what historically human behavior has done. So, for ages, credit officers have been going to small businesses, talking to them, making some notes in their mind on paper, and doing a judgment call. Is it a good customer or a bad customer, and should I lend to him or not? Now that judgment calls and was basis certain inputs. What was the input? Sir, how is your business doing? Whether your turnover would increase or it would decrease. Has COVID impacted you or not impacted you? So these kind of questions which credit officer used to go and ask. Now you don't need to do that because there is more scientific way of doing it because there is certain set of data which can answer you in few minutes without that conversation, right? So the turnaround time improves and accuracy improves. So that's why I said in GRO, what we call GRO score, which divides our customer in 5 bands. And now we have proven over a period of 24 months that our A band customer, which is defined as A band customer basis their GST and banking, performs far superior than our D band customer, which we reject all the time. And that is happening because our system generates the ability to tell us what amount of money this customer can take and what he can pay and what would be its future. So that's the one part of it. Conversion of subjective assessment to an automated data-driven assessment. Number 2, there are roughly around in small business ecosystem, more than 500 other sources of information now is getting digitized, which can be plugged into this engine. I'll give you one small example. Now, in most of the state, the electricity bill is getting digitized. So you can pay your electricity bill online or you can fetch your electricity bill through an OTP. We recently experimented this wherein we asked our customer to provide their electricity bill consumption for last, say, 12 months. And our system automatically calculated that if the GST turnover is growing by 20%, whether the electricity consumption is growing in the same proportion or not. If it is not, there is a red flag alert that either the MSME has converted to solar or the turnover doesn't seems to be genuine. Because how is that possible that your manufacturing turnover has gone up by 100%, but your electricity consumption has not gone up by even 40-50%? So this is one such example of the power of data to decision credit in minutes, for which otherwise would have taken, at least 1 month, 2 months, 3 months time for people to come to that conclusion. So I think so that would give you an answer that how the data ecosystem. I will go back to the same thing. Today, when you walk into Chroma store, when you give your mobile number and your bureau score get fetched, and if it is 700, you get a credit sanction on the spot. Is because it is now established that a 650 or a 700, CIBIL score, your credit quality or a loss ratio or a default predicted, probability of default is very, very low.
Yes.
Similar set of data can be established. What is the probability of default and what kind of loss ratios you do? And then when you add tech layer onto that, it makes life more efficient. A bank statement to physically analyze and come to a conclusion for a human being can take anything from 3 days to 7 days. A system can do that job in 5 minutes to 3 minutes time. So that's the power of technology. So there is a science which is data, and there is a process improvement which is technology. That's why we keep saying we are data plus tech company.
Okay. Okay. Noted your point, Shachindra. I want to ask one more question specifically about your business, and that is obviously we have seen some profit numbers from your company quarter on quarter, but how do you, what is the average margins that you look at? Because you have been disbursing number of loans now, you are profitable as well. So, what is the average margin size or the, that you look at?
So look, I think so. We are a balance sheet player. So unlike some of the fintechs which are in payment space or only loan origination space, we are a unique company wherein we are a principal lending institution with a very sizable capital of our own. But we have taken this view that we are also a collaborative partner. So we are lending as a service. Our job is to reach to the customer, underwrite the customers, give him the loan, but the final funding of that happens through a bank partner. That's what we call co-lending today. The UGRO is India's, I think, the most successful co-lending partner for more than 10 plus banks today. Our margins are dependent upon finally our level of maturity and what is our cost of liability. When a bank or is lending to us, at what cost he is lending, or when he's co-lending, at what fees he is paying to us. And over a period of time, that would improve. The customer, as I said in the beginning, what we will charge to the customer is depending upon his, time. So if you are what we call a prime customer in a Delhi, Bombay, Calcutta, Ahmedabad, Chennai, with a turnover of 5 crore plus, where you are completely part of formal economy, you would expect as a customer that your loan price should be sub 11 or sub 12%. We can service that as well. We make much lesser margin on that because as a younger company, our cost of borrowing is much higher than some of the old matured companies. So we might make just 2% margin on that. But for other segment of the product, so for a business loan segment where we don't take any collateral, we would charge 18 odd percent, where our margin would be almost 7-8%. But the trick is that we have to take a risk-based approach on the total portfolio. This is where we differentiate from typical fintechs, because whether the money is lent by us or through our bank partner, the risk associated with that is controlled by us. So we control how much of unsecured loan we will do versus how much of secured we will do, how much of supply chain financing we will do, how much of machinery financing we will do. So today, if I start doing all my business in unsecured, right, of the 350 crore, we do around 100 crore of unsecured loan and balance we do secured by machinery, receivable and others. If I turn that, all of it unsecured, I will be hugely profitable. But the risk associated with all of the unsecured inside would be much higher. So we control the funnel depending upon what is our risk appetite at any given point of time.
Tell me something more about your cost of funds. Because the current situation is not very, very positive. A lot of investors are going slow in terms of infusing into the startups and fintechs, though they are very interested for sure. But the risk parameters, maybe they have added a little more filters because of various reasons, whether the inflation, geopolitical risks, or most of the fintech companies could not perform well when they got listed, or many fintechs are not even thinking about profitability. Various reasons are there. How is it for you, Shachindra, when it comes to raising funds? What is the basic or the average cost of funds that you look at, and where do you raise funds from? And what is going to be your next cycle in terms of raising funds? Could you just give us some sense on that?
So I think the core difference is that most of the fintechs are only funded by equity by venture capital funds, right? And for them making, they were all increasing the top line with no sense on the bottom line, and in this hope that they will be constantly will be kept funded by the equity investor itself. Now there is a finite limit how long you can do that. In a very good market, as we have seen in last 4 years, you can continue to get funded. You can get listed even if you are massively loss making, but this doesn't carry on for a very long period of time. Ultimately, businesses have to be self-sustaining and generating cash. In UGRO, when I founded that, I was this passionate about my ownership into the company, raised all my capital upfront, which is the equity capital, and that was sizable, so that I can then build sustainable business that point onwards. Since we started, not a single quarter ever we lost money. And now we are increasing our return threshold parameter, return on asset, return on equity, margin to the business. So the only funding what we need is debt funding or partners who can fund our customers. So today, of our total 3,500 crore of balance sheet, almost 2,500 plus 2,700 crore plus would be the debt financing to us. We have more than 63 plus lender. Almost the entire banking universe of the country is lender to us. All of the public sector banks, barring one or two, all of the private sector banks, small finance bank, large NBFCs, DFIs, impact investor. I don't think so there is any lender left in the country which doesn't lend to us. We have started these relationships small and they are now scaling up. Second, we have been very focused that the liability in India or the liquidity is the prerogative of banks, and we have to partner with the bank. We started our first two partnerships with the two of the largest banks in the country, SBI and Bank of Baroda. We have been successful there, and now we have expanded that with 5 other banks, 2 large NBFCs, and few others. And every passing day, as our asset side funnel is growing, we are raising money on our balance sheet, and we are also raising, creating more partners. Obviously, as I said earlier, the cost of capital. So our average cost of borrowing today is 10.5%. People with vintage, of our similar size, the cost of borrowing would be 7%. So it would happen for us over a period of time as long as we continue to perform. So that's why if you look at, we have said FY25 will be 20,000 crore. Of which 10,000 crore will be off our balance sheet. We'll have a 4% return on asset and 20% return on equity, because now that maturity in next 2 years would come to us.
Sure, Shachindra. Now let me ask you something specifically about future or maybe outlook. So what are your future plans? What kind of growth do you see for your company maybe in next 2 to 3 years? Because the market is very dynamic. The government has been very supportive to SMEs and MSMEs, and even government has infused a lot of capital through ECLGS schemes to the MSMEs and all. And it looks like, though the situation is not very good globally, the SMEs and MSMEs are very much confident that situation will improve. And the banks are also lending, very aggressively. Considering all these changes or the developments, how do you see UGRO going ahead? What kind of growth do you see? What kind of changes are you going to make in your company? And how are you going to tap better opportunities going ahead?
Yeah, very good question. So just to give you we raised all our equity capital in July of 2018. We started our business, post ILFS in April of 19. April of 19 to March 20 was our first year. Against our 1,000 crore, nearly 1,000 crore of equity, we lend almost 850 crore only out of our equity, and then pandemic hit. During the period of 12 to 15 months of pandemic, we continue to increase our infrastructure. We have grown from 200 people to roughly around 1,100 plus people, from 8 location to 71 plus location. Massive technology investment and infrastructure built out we did. We closed March 20 on 1,300 odd crore, and March 22 we expanded rapidly and grown to almost 3,000 odd crore of assets. And if you go and look at as a listed company, we have published, I think so we are one of the rare companies who have given guidance not only for next year, but for up till 25. So our asset base would increase from 3,000 crore. It is targeted to be 7,000 odd crore. Our bottom line performance would improve dramatically from a return on asset of from 0.6. Now, because the initial cost or investment had been done, is moving to roughly around 2%. And our return on equity would go, north of around 8% or so. And if you look at FY25, we have also projected that if FY25 from 7,000 crore, we would move to 20,000 plus crore and 4% return on asset and roughly around 18% return on equity. And last but not least, last FY22, 16% of our loan book was with our partners. And this year it is targeted to be 35% or 33%. And FY25 it is targeted to be 50%. So we are building India's, we are very confident now. I don't think so we have to do anything more except just to be at it all the time. But we are very clear that GRO would emerge as, one of the large financial institution around small business financing. And we are on that path very easily.
Okay, sure. Now let me also take your perspective specifically on the industry. Like sometime back, I told you a few of the fintechs are already listed, but on the other side now, investors are going a little, slow specifically in infusing the capital in the startups and the fintechs. Though the rally in this segment is really strong, and the bullishness is still there, but additional filters are there. The another challenge is RBI is also going very strong, specifically on the lending side of the fintechs, those who are going in the NPL or PTI side of the things. Considering all these developments, Sachindra, how do you see the growth of fintechs going ahead? What kind of business models in the fintechs area or segment will grow according to you? Because everybody shifted to lending after payment because they realized they cannot make money into the payment. And now, in lending also, it's not going to be easy. That's what they realize, though data is going to play an integral part of their business. So my sense is, I would like to get the sense from you. How do you see the overall fintech ecosystem? How do you see the growth of the fintech going ahead? And what do you think will make them sustainable or profitable, to be very honest, going ahead, Sachin? I know it's a very long question, but I want you to just give your anecdotes or perspective.
So I would give this perspective. In our 4 year of journey, in spite of, GRO having a 95 plus people tech team, 30 plus people data analytic team, and massive investment in tech and technology, we never said that we are a fintech. Today also, when I'm talking to you, I keep emphasizing we are a data plus tech company. I still don't use the term fintech. So I'll give you another example. You have a Bajaj Finance, to my mind, that is the biggest fintech in the country. They don't use the term that they are fintech, right? But their traded price is reflective that they are a fintech. The problem is whatever you define as so-called fintech world is that none of them had thought through. It's like a selling a dream. At some day, at some point of time, we will make it so big that we'll be very profitable. But to achieve that dream, it may be true, but the time it would take, and during that intervening period, you need constant injection of only equity capital. More is the equity capital, more difficult it is to make return for investors. See, unlike a consumer business, right? Also even a payment business, where you have a customer and you have a platform, lending has three components: customer, platform, and the lender to us. So I can have a Ferrari, but if the Ferrari's back end, last two tires are, people who are going to give money to us are not comfortable with me, irrespective of how powerful my engine would be, I will not be able to run at a speed of 500 or 300 kilometers. And that is where the fintechs have not understood that. There is hardly all these payment platforms converting into lending. When you have to go and deal with a large public or a private sector bank, and when they ask this question, what's your gross NPA? What's your net NPA? How do you underwrite credit? How you make sure that you will be able to collect? They have no answers to that, because they are selling the dream. It is easy to sell a dream to an equity and especially a VC investor. You can't sell that to a lender. Because lender is not interested in the future of equity capital value creation. Every lender is only interested in getting his principal and interest back, and that happens only on basis of a sustainable cash flow. So I think so the fintech ecosystem is evolving. The high growth, high decibel VC funded fintechs have to take a pause and think through and build really sustainable businesses. Otherwise, now the time has come wherein people who have understood the balance sheet led businesses would now take over fintech's ecosystem at a very rapid pace because they have the capability in all respect.
Very meaningful thoughts, Shachindra, and uh, I think I should stop here, though there are a lot of questions, but the time is already up. But I think meaningful anecdotes, and I think you're somehow, that rally that you just said that, the fintechs funded by VCs absolutely just growing the balance sheet. We'll have to take a pause here. That's somehow visible now. I think the market has been evolving, obviously for sure. I mean, at one side we are seeing a great interest in the fintechs, but I think the interest will be more towards the fintechs which are actually showing a business value and not just the customer acquisition numbers. That's what the story is strongly visible, Sachin. Thank you so much for your time and sharing your thoughts here. That's a wrap, ladies and gentlemen. Click on the FinTech Diary tab to view our previous episodes as well. If you like it, please don't forget to share it on social media. Also, please ensure you're subscribed to our daily newsletter, which is absolutely for free. Thanks for watching etbfsi.com and tuning into FinTech Diary. Thank you so much.